John, Chris, back again. We've just had a really good discussion on the Speaking of Steel podcast about the EU safeguard measures and what the revisions will mean for the steel market across Europe. Really useful, but the burning subject for a lot of people remains US import tariffs, and we can't go a month without talking about it to some degree. So we're going to see how the most recent announcements on reciprocal tariffs and I guess the auto tariffs pan out. But what we can reflect on now is Section 232 and what we've heard back from our market participants and contacts in the last month or so. John, can you sort of outline a bit of Section 232 and where we are sort of up to date with the US steel tariffs?
Sure. So 2018, the Trump comes in and starts talking about protecting the US steel industry. Section 232 is the mechanism that allows him within US law to do this. And in order to invoke that, he's basically got to say that the US steel industry is critical to national security. So that happens, and it gives him broad powers to essentially introduce import tariffs. That's when the 25% tariff goes on onto imports into the US. Very soon, though, it seems that there was a whole bunch of exclusions, exceptions. There were countries able to negotiate sort of quotas against these tariffs. There were companies in America allowed to say that we need this material, we need it without the duty, and that got that material sort of exempt from these duties. Fast forward through to 2025, and essentially what we've seen now is all of that resetting. Any material going to the US is going to pick up that 25% duty. So anybody that's managed to negotiate those exceptions, gone. Anybody who said that they need that material, gone. It's all there now as a standard blanket 25% rate.
Simple.
There we go.
Very straightforward. Easy to take in. I mean, of course, as we said before, things are unfolding all the time. But essentially, well, I'll turn to you, Chris, because you're researching the US, North America every day. What's been the response so far? We're a few weeks in now. This was March 12th.
Yeah, I think like John mentioned there. Obviously, there's a lot of similarities, a lot of parallels to what happened in 2018. I think, like John said, simplistically, the 25% is across the board. It's almost created a level playing field. I guess the countries that would feel naturally disadvantaged is the ones that had the quota in place. So obviously the near neighbours, Canada, Mexico, the likes of Japan and Korea, Argentina, Brazil. I guess they were the ones that had country exceptions that they're able to obviously service the US market within obviously quota limits. I think at the moment you see something from two perspectives. I think in terms of those countries who had the quota, but that's certainly not in place. I think they would naturally feel the most impact at the moment, and I think that's certainly being felt in Canada. We have the luxury of seeing the perspective from both sides of the border, and I think obviously the Canadian market in nature is very exposed to the US market. It's almost, in terms of price demand, it's almost running in parallel or tandem. And I think since there was talk about the tariffs, actually at first on all Canadian and Mexican goods, and obviously that was postponed further down the line, but now we know it's on 25% on steel and aluminium, then certainly companies have been looking at their order books very closely and look how they can mitigate that risk. And we've certainly found from a procurement point of view, people will always look for alternative options, whether that's Europe, Asia, for alternative sources of supply. But from a sales point of view, I think naturally people are finding that their sales channels are limited or potentially closed based on the measures in place. And I think typically the steel makers, so you kind of do an example, the big three there, the Dofasco, Stelco and Algoma, they've had to react pretty quick really, because the US will have formed a big proportion of their order book. And again, they've had to sort of manage that risk, not just on the speculation of the tariffs, but now the implementation of them. Interestingly, on the other side of the fence, I guess literally, in terms of the US, I think uncertainty has been managed. I think again, there's been a cloud and air of uncertainty, but I think the mills quite cutely and I guess naturally in many ways have capitalised on that uncertainty. They've taken advantage of that. They've almost had free reign, particularly in the Midwest region, given the likely absence of Canada, to raise prices with pretty minimal resistance from buyers. And for instance, we have seen hot roll coil prices go from a low of $650 US dollars per short ton to now over 900, and potentially there's $1,000 per short ton in sight. So again, the mills have taken advantage of that situation, possibly being kept quite cute in limiting spot availability, again, to maybe push through their own pricing ambitions. And we've even seen that service centre distributor level, where a lot of US service centres are seeing the opportunity to sell for a higher price tomorrow than what they can today. So interestingly, we've looked at things from both perspectives. You get the uncertainty is across all areas, but I think obviously the US market being able to manage the change. Obviously, the Canadian market is more heavily exposed to that, and that's something that's been clear from our certainly our March discussions and our ongoing talks as well.
Making the job of MEPS research a little bit more interesting, I guess. There's a decoupling of those two markets and pricing as well going forward.
Yeah, exactly, Tom. Yeah, I mean, that's something that we've seen over time. We've tended to find that, particularly again for flat products, the US and the Canadian prices, barring exchange rate fluctuations, have almost run in parallel. And interestingly, in terms of the tariff talk and then the implementation on steel, we have seen Canadian producers jump on the bandwagon, if you like. So they have raised their prices like they have in the US. But there is a feeling that while the US prices will go up and be maintained at a relatively high level, that in Canada there will be an element of decoupling because the mills there are finding that their exports to the US will be limited. There is the high prospect of, if they can't find other export channels, which is not going to be a short-term solution, whether that's Europe, Asia, or elsewhere in the world, that will cause an oversupply situation in the local market. So there is a feeling and a perception in Canada that they're holding back because they feel any momentum that's behind pricing will soon be lost in the next couple of months.
Yeah, I think one thing we've talked about in recent weeks is just the geography of the Canadian steel industry. It's sort of been brought into sharp focus by this situation. A lot of it's located very centrally, isn't it? Primarily to serve that US market. How tricky does it become if that door is shut?
No, it does. I mean, in terms of the Midwest region, yeah, I mean, people, the buyers we talk to, again, from both sides of the border, will see whether it's a US or Canadian supplier. That in the past, they've almost seen it as one, but now they've had to make a clean break, if you like, or clean distinguish. I think in the run-up to the deadline, we saw those who traditionally bought from Canada and vice versa, a little bit of a run of activity, trying to beat the deadline. Now, I think we're starting to see the reality of the situation hit home, and we're finding that Canadians are typically buying from Canadian mills, and the US guys are typically buying from the US. So again, we're seeing that decoupling not just in prices, but in terms of procurement as well.
Mm-hmm. So, John, I gather that all these tariffs that Donald Trump, I guess, in the first instance, is talking about, the administration itself is implementing, they're all cumulative, aren't they? We've got a few potential things that are coming along that could raise that percentage way beyond the 25% for certain steel products and other items.
Yeah, so for the iron and steel products, you've got that 25%. Unless, of course, you're coming from China. Then you get also the additional tariffs that apply just on Chinese material. Then, if we start looking at, so this is the easy bit. Then, if we start looking at sort of, say, some automotive material that's potentially got to cross the border several times, with the automotive tariffs that start in April. Each time that material crosses the border, potentially tariffs are applied. Each time that piece of steel gets further worked into another item, it could pick up more tariffs. But then, of course, it'll only pick up tariffs on the work or the material that wasn't from the US. So that's very quickly going to get really, really complicated. Beyond that, we've got the reciprocal tariffs. So it's going to get very, very complicated very, very quickly.
And it's interesting just picking up on a few things that John mentioned there in terms of the delicate supply chains, particularly, well, for auto and a few other steel end segments as well. I think we get the feeling from, again, the talk and the soon implementation of the measures that there is a feeling that car makers, from both sides of the border, will pay the tariff because, as we know, through those delicate supply chains, that it's not easy to secure approvals, not easy to secure certification. It's not a quick fix. So there is a feeling that in the short term, the car makers will pay the burden of that cross border links. But obviously, over the medium and longer term, people will be looking to secure. If the measures are maintained, they will look to secure domestic supply at all costs. But again, that again's not something that can be done overnight. It will take time, but I'm sure it'll be a trend that we will see in the longer term if the measures are maintained. In possibly a second point, if I may, I know in terms of we see the tariffs as obviously a threat. So obviously those who had the existing quota, I think that's quite clear. They will feel clearly disadvantaged from the position they were not so long ago. But interestingly, there's another school of thought that actually the tariffs do present an opportunity. So as we've seen in the US, for instance, hot rolled coil prices have gone from 650 to 900, and it's almost, again, created that level playing field, and it's almost brought traditional exporters, those who have access to low cost production, I guess name checking the likes of Egypt, Vietnam and the likes, it's almost brought them back in the game again. And actually talking to people in March, imports are now back on the radar, they're being talked about, and there is a feeling that coinciding with the open navigation, that actually imports around that 800 US dollars per short ton will become attractive to buyers again. So again, the tariffs are designed to maybe prevent imports hitting US shores, but actually in some instances it could be actually counterproductive, and we may actually see that trend emerge, albeit with the caveat that the goalposts don't move again. So again, that's something that we have to keep a close eye on, but not just a threat, but maybe an opportunity for some as well.
Yeah, and I guess in that scenario, the risk for US-based steel buyers is that they become the most expensive market in the world, potentially.
Yeah. I mean, that's not something that's totally uncommon. I think traditionally through historically, the US has always been seen as the highest priced market in the world. I think we obviously saw that pricing gap narrow in recent times. But again, the recent stimulus spurred or the catalyst by the tariffs has enabled US prices again to escalate quickly in a short period of time. And again, they're becoming an attractive proposition where people might feel, well, you know what, we'll bear the burden of the 25% and we'll try and maximize volumes to the US. But again, that's okay in theory. But again, that's with a caveat that further tariffs or further measures won't be implemented like we've seen on auto and what we're likely to see on other products as well.
Yeah. John, it's very early days, admittedly, but have we any idea at this point what effect this effective closing of the US market, or uncertainty, we can certainly describe it as that at this point, is going to affect steel prices elsewhere in the world?
So I think there's two main factors to this. First of all, there's that displacement of material that was going to be going to the US. That's going to go somewhere else. That's going to naturally increase supply, which pushes down prices. I think the other part of it, though, the much more uncertain part, is the issue around how other countries retaliate to the retaliatory tariffs. And that's yet to be seen. That's the bit that really concerns me, because that could be the bit where we get that spiral, and it's going to get to the point where who really benefits from that?
Yeah, I mean, we're looking very much at the steel angle, but there's obviously an economic emphasis to this as well. I mean, it's been well publicised that maybe the flip side of the tariffs is that generally it will cause US consumers to pay more for whatever good, whether that's steel or other goods as well. It will cause inflationary pressures. And I guess whether we're in the US or whether in Europe, people are crying out for that relief, if you like, for interest rates to come down, the cost of borrowing to come down, and then they have the confidence again to buy and invest. And invariably, if tariffs are in place and a trade war does ensue, which could be a likely scenario, then economic theory in some ways does dictate that there are no winners, and we will see growth under threat, and the knock-on consequence of that will be interest rates will come down slower than people would want or anticipate, and again, there's obviously losers as a result of that.
Yeah, of course. Prices are going up, and the president wants to see that price difference go into the coffers of the Treasury in the US, I suppose. But ultimately, in the steel market, if you're buying or selling, it just makes life very tricky, doesn't it?
It does. It does. I think generally across supply chains, generally most steel supply chain participants will welcome a price increase. I know, again, talking to people in the US, not just the mills, but the service centre distributors. In some ways, they're very welcome of the higher prices. But again, we have to see the pinch points further down the supply chain and see. Well, ultimately, that's going to affect the end users, the sort of the competitiveness further down the supply chain. So again, no measures come without a cost. In the short term, people may welcome the higher prices as long as they are passed through. But I guess that will remain to be seen.
We talked quite early on about the sort of the glide path of Section 232 from its founding in 2018 in the first Trump administration. There were exemptions quite early on for things that people wanted to buy in the US market, wasn't made domestically. What's the likelihood that that happens again? I mean, they can't just have their supply cut off, can they? But I guess if they're willing to pay more for it, that's the solution.
That I think is the gambit Trump's trying to play at the moment. It's all the talk that he has put out at the moment is that yes, we're willing to bite these at these extra prices. We're willing to pay this. Whether that is just a negotiation tactic, whether there is potential for some kind of exemptions, I'm not so sure this time. I think it'll be much more difficult, and you'll probably have to concede a whole lot more in order to get those exemptions. So once again, it comes to that balance of the steel industry and the wider economy, and that's going to be something that each government, each nation is going to be sort of evaluating slightly differently.
And interestingly as well, I guess what people have mentioned to us again over the recent months, it's almost the uncertainty that has almost caused a state of paralysis, if you like. It's almost that state of flux, not knowing what to invest, what to place. So actually, by having the measures in place, at 25% across the board, I guess a level playing field, if you like, then people can plan ahead with a degree of certainty. It does feel slightly different this time compared to 2018, where a lot of the exceptions and the waivers were in place actually prior to the implementation. This time, the implementation has gone ahead, and you can imagine the bureaucratic nightmare, the red tape nightmare, that discussing specific deals with specific countries in terms of the logistics of it. But the flip side of that is the US will have products, it will have items that, again, cannot be sourced too easily domestically. So from a practical point of view, whether that's related to energy or particularly defence and military, again, further down the line, there may have to be exceptions on a case-by-case basis. But at this point, the rules do look to be in blanket form and typically across the board.
Yeah. A lot to still take in. As we say, the story's unfolding virtually as we speak, and there'll be more announcements to come. It's ever evolving. So, what are we looking for? What's the outlook for the US steel market, John? I guess going forward, is it possible to predict? We've got forecasts. We know what the prices will roughly do, but in terms of sentiment, it's difficult to read, isn't it?
It is at the moment, and it's going to stay that way for quite some time. I think it's going to take a little bit of time before we find this new equilibrium of where prices are going to end up. Our immediate forecasts, I think they've actually been quite good. Our forecasting team, considering all of the issues, not just in the US but in Europe, they've been very, very close with their forecasts. As we go a bit further beyond, I'll leave that to them to decide.
Absolutely, Chris. Sentiment going forward. I mean, the outlook. Do you think will it just remain uncertain, or are buyers and sellers likely to?
Well, I think at the moment the mills, or whether it's people on that first rung or two of the ladder on the supply chain, I think they're riding the wave a little bit at the moment. So everyone's enjoying the the higher prices that are on offer. You do get the feeling from the discussions that people are quite skeptical that the rises that we've seen, the foundations aren't there, and it's pretty much on fragile ground. Again, the threat of inflationary pressures, the talk of recession, obviously, again, are in the back of people's minds. So again, we've obviously seen a short-term impact, but again, there's question marks over the medium to longer term. That obviously the tariffs, if a trade war does escalate, then it will impact on growth, and it will impact on the economic prospects. Which again, any price rises, again, not with the foundation of demand support or the required fundamentals being in place, will naturally be pretty fragile in nature. So again, the sentiment we get is that short term riding the wave, but longer term there may be doubts to whether those kind of price levels will be maintained, or if they're maintained, maybe to not the degree that they are at the moment.
Yeah, and I guess one thing we need to keep an eye on, which we've mentioned there, John, is automotive as a sector is so important to the European market, the Asian market as well. There's a lot of cars built in the US, of course, but still, does it satisfy customer demand?
Well, that's it. We've seen several companies now announcing they're going to open new plants in the US, and that's even before these tariffs actually kicked in. So there is certainly reason for having these tariffs if that's the change in behaviour that it causes. One of the big points that they keep bringing up is the export of cars from the US into other countries, into other regions like Europe, and if those prices do go up the way that we're kind of expecting for those cars, for those vehicles, it's going to be even more difficult for them to try and find an audience over in Europe. Especially when we've got the Chinese sort of new energy vehicles being made in the millions. I think it's going to be very difficult for them.
No winners in a trade war.
No, certainly not.
No, maybe not. Gentlemen, we'll leave it there, but thanks ever so much for keeping us up to date on the US tariff situation. As I say, moving very fast, so we'll keep an eye out and hopefully try and keep up with progress as it moves on. Guys, thanks ever so much.
Yeah,
thank you
for joining
Thanks,
us.
Tom. Appreciate it.
Bye-bye.
Thank you.